Hi, everybody. This is Alan Elman, the Blue Collar Investor, and welcome back once again to the Beginner's Corner Information Series, second edition. We're now up to lesson 6, executing a covered call trade. What that means is we've identified a stock and we've identified an option that meets our goal. At this point in time, we're ready to start trading and making some money. Now, we have to first get a reliable online discount broker. There are a lot of them out there now competing for our business, and trading commissions are getting lower and lower and lower, and I believe heading to zero. For a file on online discount brokers, go to that very same link I've been talking about over the last couple of lessons, where we can get a free file right here, the free resources link. We've got the calculator and the banned stocks file. There's also a file of reliable online discount brokers with trading commission information. Now you have to kind of update that periodically. As I said, commission fees are going lower and lower and lower as they compete for our business. Once we have a brokerage account set up and we've mastered the 3 required skills, stock selection, option selection, and position management, we're ready to start making money. Now, there are several types of broker orders. The 2 main ones are market orders and limit orders. A market order is an order where we instruct our broker to buy or sell at the current best available price. We're kind of leaving it up to them to find the best price for us. I use these when I'm buying or selling a stock or an exchange-traded fund. Usually the liquidity of these underlying securities are large enough so that we're getting a fair price by using the market order. And those are usually executed very quickly. Now, the limit order, where you're giving them a specific price or better, is best used when you're dealing with the options, because a lot of times we can actually negotiate with the market makers on a better price. That's where you have to use limit orders. So a limit order is instruction to our broker to buy or sell at a specific price or better. Okay, once again, market orders for stocks, limit orders for options. Now, there are 2 main types of trade execution forms. Most people will execute a covered call trade in 2 steps called legging in. And in legging in, we first buy the stock. Remember, we are then in our covered or protected position. And once we own the stock, we're then free to sell an option. With covered call writing, a lot of times we're just writing calls on stocks we already own. So we're just doing the second step in the process. Or while we're doing our position management, something we'll get to the next lesson, while we're doing our position management, we may buy back an option and then sell a different option. So we already own the stock. And that's why it's good to learn this process via the 2 steps. So buy a stock, you're covered and protected, and then sell the option. The other way of entering a covered call trade, and some brokers have what's known as buy-write combination forms, and that's where you're buying the stock and selling the option in one form, which results in an instruction to our broker to buy at a net debit limit order. So when we buy a stock, the stock costs more than the option that we're going to sell. So that results in a net debit situation. We have to pay money to enter the trade, hence the word debit. And the debit is the stock price minus the option premium. So once we decide on the stock and we decide on which option meets our goal using the moneyness and using the initial time value return, then we combine those 2 and make the instructions to the broker. All right, let's start with legging in. First thing we do is we go to our trade execution form and we want to buy a stock. That's what we remember. We're giving instructions to our broker what to do. So you put in the ticker symbol, how many shares you want, and we could use a market order. If you prefer a limit order, that's fine too. And then, of course, it's a day-only trade. You don't want to leave it lingering for a while. Things might move against us. So it's a day-only trade. You could trade in a cash, which is my preference, or margin account. If you're doing a cash account, it would apply to IRAs. You may have to use a margin account, and then you're ready to go. And then eventually the trade will be executed, and then we're ready to go to the next step, leg 2, which is options. So we're going to click on the transaction type, which is options. You see the drop down over here. What do we want to do? We want to sell a covered call. What's the stock? KIRK. What's the expiration date and the strike price? You put all that information, the number of contracts. Remember, we're going to use a limit order, and you put in the limit order. Once again, it's day only. Count was margin as from before, and then you're ready to go. And if you're asking for the published bid, it'll be executed immediately. If you're going to negotiate, may not execute immediately. I teach you how to do that in my books and DVDs. But for this program, we're going to assume worst case scenario, the published bid price. Now, if we were going to do it all as one form, we enter the trade as follows. We buy the stock, and in this case, we're buying BCI 300 shares, and we're buying it. In the same form, we're selling the option. So you notice here it says sell to open. We're buying the stock, and we're selling the option. It may say STO instead of sell to open. And now we tell them what the combined purchase price versus option premium we want it to be. In this case, $27.50. So any combination of stock price and option premium, the most we're willing to spend is $27.50. If the broker can execute it for a lower price, that would be great. But we're establishing the parameter of $27.50 or lower. Now, if we're ready to close that trade, we would be doing the opposite. Instead of buying the stock, we're now selling the stock. Instead of selling the option, we're buying the option. We're buying it back to close. Buy to close. It may say BTC. But we're also giving a number. The number here is 2840. So 2840 or higher would be the parameter we're selling. So if we sold it at $27.50 and we're buying it back at $28.40, then we've made a $90 profit. All right, so the 2 steps with the buy right combination form is the net debt limit order, debit limit order, and then a net credit limit order when we're closing the position, because we're getting more money for the stock than it costs us to buy back the option. Again, most of the time we'll be legging in. One of the advantages of the buy right combination form, which some brokers have, is that the trading commission might be a little bit lower, but then we're losing out on our ability to negotiate with the market maker. Let's summarize executing a covered call trade. It can be executed in 2 different ways, legging in 2 steps, or with the buy right combination form where we set up a net debit limit order or a net credit limit order. Orders can be entered as market orders, where we're asking the broker to get us the best price, or limit orders where we establish a parameter at that price or better. It's important to select a reliable, inexpensive online discount broker. Once again, you can get that file at the free resources link on the top black bar of our web pages. And that concludes lesson 6. In lesson 7, we're going to discuss position management or exit strategies. That will be the longest of these videos. And so hope you enjoyed this video and look forward to seeing you at lesson 7. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.